There are a few things that I dislike more than packing for a vacation. As I'm sure many of you can probably attest to, packing is usually the worst part. But one of the parts that really drives me crazy is then trying to fit everything into the trunk of the car that we're taking. Oftentimes, we may find that we overpack, which means you got to cut something out and leave something back, or you underpack. In other words, you got much more room that you can fit some things into. By that point, it might already be too late before you're ready to pack and go forward. So, being that that's the case, you want to make sure that you maximize your trunk space, but also pack as much as you would like to take. I view tax planning as no different, especially in retirement. What we want to try and do, instead of fitting everything into the trunk, is fitting as much possible into our tax brackets that we can reasonably allow. And these tax brackets are usually going to be less than they would be potentially in the future because of a varying number of reasons, such as additional Social Security income, perhaps a required minimum distribution that you may have, or a pension that you could be looking at down the road. Regardless, it's best to take advantage of low tax brackets while you have them because we don't know if they're going to be there forever. And today's video is about discussing how you can best do that, but managing the difference between Roth conversion planning and capital gains harvesting planning. So, covering the two, we'll get into that. But what we want to make sure of is that we look strategically at which one would be better in a given year and which one would be better over the course of your lifetime. It's not a one size fits all answer. And depending on your situation, one strategy may make more sense than the other. If we've not yet met, my name is Danny Cieniewicz. I'm a CFP professional from Hyperion Financial. Be sure to check out the link in the description below where you can fill out your quiz to have a better idea of how strategies in retirement to lower taxes can best be utilized. And if you haven't checked out our website yet, you can get yourself a free assessment clicking the link in the description below. You can see exactly what a sample assessment looks like here. And if you do complete this and fill out some of the necessary information, you can run through your free assessment. As I often like to do in these videos, I think it's best to actually use a case study to talk through to make sure that we can get a feel of when you should be looking to take advantage of capital gains harvesting, when you should be looking to take advantage of Roth conversion planning, and perhaps how you can look to actually do so in a combination strategy as well. Let's just start by meeting our fictitious couple, Mike and Sarah. They're both 62 years old and early retirees. Mike and Sarah have a combined $800,000 in a traditional IRA, and then they have $600,000 in a taxable brokerage account with $200,000 of unrealized long-term capital gains. The annual income need for Mike and Sarah is $80,000. Now, they can take more if they would like, but as far as their need would be concerned, they need $80,000 per year. And since they're both age 62, the required minimum distribution age is age 75. So they have 13 years before their RMDs would begin to kick in. Now, generally, Mike and Sarah would be presented with two different options. The first one would be to pursue aggressive Roth conversions. In other words, getting as much out of that pre-tax account and moving it to a Roth account as possible before their RMD age. The other option would be the capital gains planning or the harvesting of capital gains and getting as much out in the 0% capital gains bracket as possible. If you're looking at options between the two, with option A, aggressive long-term Roth conversion planning, you can look to convert a significant amount each and every single year until the age of 75. The good part of that is that you can get the pre-tax account taken care of. These dollars are no longer considered taxable. And at this point in time moving forward, you now have a Roth asset. However, the downside is that you're going to be paying taxes along the way and perhaps at a higher rate than you maybe otherwise would be paying, but you also let your non-qualified account continue to grow and those capital gains continue to grow as a result. So you're solving one problem at the behest of another one. The alternative option is to look to be aggressive on your capital gains strategy. Look to harvest as much as possible in every given year and get that capital gain as close to zero as possible. Again, if you do this, the benefit of this is that you no longer have a long-term capital gain to worry about inside your account, at least not in the present time, but at the behest of your pre-tax account growing, in which case your required minimum distribution could continue to grow starting at age 75 and continue throughout your lifetime. Now, each of these two different scenarios will present one positive, but potentially a sizable negative depending on your situation in retirement. The good news is, though, is that you can actually look to begin to tackle both. And the even better news is that you can look to do so in any given year and mix up the strategy accordingly. You don't need to necessarily be beholden to just one strategy over this entire time. You can outline a game plan, but then adjust accordingly from year to year because there are going to be things that change, whether that be rules in Washington or legislation changes that could take place, The market could change, interest rates could change. Nearly all these things will change over a 13-year time period, and you should make sure that your plan is taking advantage of these changes when they do in fact occur. So let's actually dive into some of the strategies just a little bit further. Let's start with some of the capital gains planning. So what do we actually mean by the fact that you can recognize these at a 0% rate? Well, what's important to understand is that income is taxed differently in retirement, and it's taxed differently depending on the type of account that you would. Now, retirees can have a number of different assets or a number of different accounts, but to keep it simple, we're just going to refer to pretty much the three accounts that most retirees would be familiar with, at least from a tax perspective. The first one are pre-tax accounts, the second are Roth accounts, and then the third are non-qualified brokerage accounts. These are also referred to as after-tax accounts. With after-tax accounts, you're going to have a cost basis, and that cost basis generally is made up of money that you've already paid tax on. So in other words, if I fund an after-tax account with $10,000 and it grows to $100,000, assuming I haven't paid a tax on any of the growth as a result, then $90,000 of growth would be subject to capital gains tax. With short-term capital gains, if I hold those funds for less than a year, I would have to pay those, and they would be taxed as ordinary income. But long-term capital gains rates are taxed more favorably. And as you can see at the rate here, you're going to see both married filing jointly and a single bracket and what that would look like. Notice that you could actually pay at the federal level anyway, a 0% tax on capital gains up to a certain threshold. Also understand these are marginal rates. They are not a cliff schedule. So in other words, if I go $1 over these rates, it doesn't necessarily mean that all of my capital gains are subject to the 15% rate, just the amount that goes over that first threshold. The other thing that's important to understand with this is that your standard deduction would apply to this income as well. So if the only income that I was bringing in was long-term capital gains income, I can apply the standard deduction in addition to any of the bracket that I have here up to the 0% rate. So as a result, you can recognize a significant amount of income. And as a matter of fact, we did a video on that not too long ago, which I'm linking to right now. And that allows you to harvest capital gains, which would normally be taxed at 15%, at the 0% rate up to a certain threshold. So a quick example for a married couple, specifically ones that would be over the age of 65. You have the standard deduction of $31,500. When you're over the age of 65, you get an enhancement. And if you're married filing jointly, it's $1,600 per individual who's over the age of 65. So a maximum of $3,200 that you can take advantage of. The recent Trump 2.0 tax cuts, or the One Big Beautiful Bill, allowed for an additional $6,000 standard deduction per individual, so long as you're under certain income thresholds. Assuming that you are, that's another $12,000 of standard deduction that you can take advantage of. And then when we account for the 0% capital gains rate of $96,700 in the tax year 2025, we're looking at a total of $143,400 that can be recognized at a 0% rate. In other words, there would be no federal tax that would be due on this income. So let's talk through this real quickly. If the only type of account that I would have is a non-qualified brokerage account, and the only type of income that I would be receiving is from that non-qualified brokerage account, and me and my wife are both over the age of 65, we'd be able to recognize $143,400 in tax-free income at the federal level. Now, that's not always necessarily realistic because plenty of folks have more than just non-qualified accounts. Many retirees have pre-tax accounts, and in some cases, they also have Roth accounts. But in the event of pre-tax accounts, one popular strategy is to consider utilizing Roth conversions. In other words, moving dollars from a pre-tax account to a Roth account in a given year. When you do this conversion, you are subject to pay the tax in the year in which you complete the conversion. And the reason why retirees may want to consider doing this is because they're in a lower tax bracket now than they will be in the future. As a matter of fact, that's really the major reason why you should be considering Roth conversions, is taking advantage of low tax brackets now compared to what tax brackets will look like in the future. And in the event of retirees looking to consider this, nearly every retiree who has a pre-tax account will need to take from their pre-tax account the required minimum distribution. The required minimum distribution is taxed as ordinary income. And when it's taxed as ordinary income, that can drive up income tax along with a bevy of other taxes, such as your Medicare premium surcharges, net investment income tax, Social Security tax, etc. So having a high RMD is not necessarily a good thing if you're looking to keep your tax liability low in retirement. Understanding this, there's a long-term impact that can be felt here. The more that you're able to convert traditional to Roth at a lower tax rate, the better situation that you could find yourself in. So what are the common mistakes that we see when we're comparing these two? Oftentimes it can be going all in on one strategy when it may make sense to consider a hybrid approach. For example, the all Roth all the time mistake that is often made. This could be a situation where folks would be willing to make a larger conversion in which they would cross different tax rates, have to pay Medicare premium surcharges, when they could look to take advantage of both Roth conversions and look to take advantage of capital gains harvesting. This approach just completely ignores a 0% capital gains rate and instead may focus on the 12% to the 22% bracket of the Roth conversion strategy. Conversely, the second problem is not converting anything. And in this case, assuming that the traditional IRA is properly invested and is doing well in a market run up, while the account balance will continue to grow, which is great, the RMD will continue to grow along with it. And a rising RMD can also create other issues. And we've also done a video on the problems that a rising RMD can create, which again, I'm linking to right now. But the worst mistake that you can make is instead not making any action at all and just having paralysis by analysis and not moving forward with any strategy. When this happens, you're leaving a significant amount of trunk space in any given year when you should be looking to take full advantage of that. If you're not going to take advantage of low tax brackets now, there's no guarantee that they're going to be there in the future, especially if your accounts continue to grow. While it's a good thing that your accounts continue to grow, it's better to pay the tax along the way rather than being faced with a massive tax bill down the road. So what will we do in the case of Mike and Sarah? How will we go about actually conducting a strategy that could help with this? Well, the first thing that we would want to look at is taking consideration of what their actual plan would be and what their goals are. Being that they have $800,000 inside of a pre-tax account, no Roth assets, and $600,000 in a taxable account with a $200,000 long-term capital gain, we can look to see if we can take advantage of both of these strategies. We want to make sure that we cover income for their annual need, and we also want to make sure that we're taking advantage of the tax brackets that are in place. Now, the other thing that's important to understand is there's a timing aspect to this as well. The timing aspect being that there's 13 years until the required minimum distributions would begin. Now, there's no guarantee that that date's going to continue. It could, in theory, be moved up earlier or later. But as of right now, as the rules are written, age 75 is the year in which they have to take the required minimum distributions. And the other thing with RMDs is each and every single year, the multiplier amount would go up. So as they get older, if their account balance stays level or continues to grow, their RMD would continue to grow. So as far as the framework would be concerned, what we want to do first is fill the ordinary income tax brackets by the standard deduction. Understand, too, that the ordinary income and capital gains income work together when it comes to actually considering your overall modified adjusted gross income and your taxable income. However, they are taxed at different rates. But when it comes to the standard deduction, you can look to utilize that first on your ordinary income. Since ordinary income doesn't get that favorable treatment of the 0% tax bracket that capital gains income does, it's best to have that wiped out by the standard deduction first. So in other words, they could look to do a conversion of $31,200, and that can help actually be covered by the standard deduction. So the first thing that we want to do is make sure that we fill that deduction space with ordinary income. From there, the two things that we want to look to do are to fill up the 10 and the 12% brackets of ordinary income, along with the 0% bracket on the capital gains income. Once we have these accounted for, we can then make the decision of if it's worth to further harvest at the 15% capital gains rate, or if we would want to look to go to the 22% bracket. Now, in this example, both Mike and Sarah are still just 62. So they still have 3 years before they're able to get some of the enhanced standard deduction features to that as well. So if they have $31,500 of standard deduction that they can take advantage of, that can be filled with ordinary income. They can also look to do both a conversion and a capital gains harvest. The conversion would be about $35,000 and the capital gains harvest would be about $30,000. The capital gains harvest would be at the 0% rate. The conversion would be at about the 12% rate. So the 12% rate would save them ideally about 10% if they were later to be in the 22% tax bracket on a future RMD. The capital gains harvest of 0% would also save them 15%, being that they need $80,000 to live off of. They can take advantage of $96,700 of income in this situation. Now, what we also want to keep in mind too is that since there is a cost basis that's currently inside the taxable account, not all of their distribution is going to be subject to capital gains tax. Therefore, they can create a strategy that allows them to both live effectively and cover their annual need and then some, but also make sure that they're paying the minimal amount of tax that they would owe. And there are two caveats that I think are important to understand before you go ahead and move forward with any specific strategy. The first one is that you also understand how state taxes work. And being that state taxes are going to vary across the 50 states that we have, income tax and capital gains tax are going to be factors that you should be considering. Some states will tax Social Security, some states will tax pensions, and some states will tax IRA withdrawals. Others may not tax any of those, or maybe one or two of those. Some states may tax capital gains, others may not. Regardless of how this shakes out, you want to make sure that you're taking into account both the state tax and the federal tax implications of this strategy. The other thing is your legacy planning that you want to keep in mind. As far as legacy planning would be concerned, passing to either a surviving spouse or to children when it comes to traditional assets is a lot different than if you pass non qualified assets to them. Well, again, these rules can change on a dime. As it currently stands, it's far more efficient to receive non qualified assets than it would be to receive pre tax assets. And the other thing to keep in mind are your charitable contributions or your charitable inclinations. If you're planning to leave all your funds to charity, as opposed to leaving them to a child or to somebody else, you also want to keep in mind what that means from an inheritance standpoint. So, with all these factors in mind, this can also help determine a strategy of which one should take priority over another. To summarize, I think it's best to make sure that you at least have a strategy in place and that you match your goals with your actual tax strategy. If your goals are to pay as little tax as possible, and you're not exactly sure how to do that, check out HyperionFP.com and understand how to get your free assessment to make sure that you have an idea of which strategy would most favor you. Now, when it does come to actually setting up this strategy, lowering tax is great. But if you don't know exactly what you're going to be doing with those dollars, then there's no point in even freeing up that trunk space for a vacation. Knowing where you're going to be traveling to and the thoughts behind that become very important. And understanding your most important number in retirement is to find out what that most important number is. Be sure to click right here.